Welcome to Leaders in Business and Investing. I'm your host, Paul Gray, and today I'm excited to introduce you to Mr. Matthew Peterson from Peterson Capital. Matthew brings a wealth of expertise and insight into the world of finance and investment. Matthew, thank you so much for joining us here today.
Paul, thank you so much for having me. It's great to be here.
Matt, I thought a good way to get started would be to ask you an easy question. What the heck is going on in the world today with these tariffs and everything that's going on in the stock market?
Great question, Paul. I mean, this is a very unique situation in history, although these fluctuations and volatility do recur commonly. So what's going on today is, of course, a little bit different in terms of the political and geopolitical events, the tariffs, et cetera. But the outcome is sort of similar, where we have increased volatility, some downward pressure on prices. And the most important thing at this point is that everybody remains focused on the long term. These volatile periods, for a value investor who's looking at the long-term intrinsic value of a company and evaluating cash flows, these present opportunities. So when there's volatile periods and prices come down, market psychology, the herd mentality tends to move to extremes. So that's where you get mispricing. That's where you get strong opportunities. And when you have a volatile period like this, I have found that the most impactful thing you can do for your portfolio is upgrading quality. So there are very few times that you get really outstanding businesses with great management teams and growing cash flows that trade for a reasonable price or something below their intrinsic value. The only time that happens is when you have uncertainty in the markets, fear in the markets, and volatility in the markets, where you get a mispricing. And so these next few quarters are probably going to be an opportune time to invest your cash in high quality businesses. You don't need to make your money you don't need to make your money back the way that you lost it. So if something's come down and you don't like the quality of that position, you can exit that holding and move into something of higher quality, and you'll do quite well coming out of this. So what is happening is there's a lot of political posturing. There's a lot of volatility. Of course, I look at what's happening in the Trump administration as a way to balance budgets. The U.S. has a major deficit issue that's been looming for decades and growing, and it's become pretty unsustainable.
Exactly.
And so something needs to happen in terms of increasing revenue and cutting costs. And that's a difficult pill to swallow, and it's something that we probably need to do. Maybe things are coming across a little bit harsh, and it's really making markets participants concerned. But I think this is a great time for bottom-up analysis. These tariffs are going to impact every individual firm in a different way. And so it's very important to look at individual situations and understand exactly what's going to happen to their earnings. And then you can start to ask, how much will the multiples contract or expand during this period? And then the volatility should give you great opportunities.
Amazing. Yeah, with that being said, I did a conversation not too long ago with Joel Greenblatt, and one of the things he was saying was, he was referencing the fact that a lot of people in media think that value investing is dead. But he said it's not dead, it's just sleeping. In your view, Matt, do you think it's coming back? Do you think this is the moment it comes back? Or does it just come back in cycles, kind of similar to what we saw in 2020 with the pandemic, or even 2022 with the big, tech bubble?
Yeah, great question, because value investing is inherently challenging. It's very academic. You have to understand all the theories and how they work in practice. You have to generally go through extensive training to be capable of understanding the value of these complex entities, and then comparing across all the entities and finding these needles in a haystack will ever be dead. All investing, I think it was Charlie Munger who said, all investing is value investing.
Correct.
I mean, you're trying to buy something for less than the future value. So if you're not value investing, then I suppose you might be speculating, hoping that somebody else will pay more for something that you've purchased in the future, where that may even be an irrational price that they're willing to pay. So I like what Greenblatt said, that that value investing is sleeping or resting,
Mm,
because ultimately what happens is the markets go through these extended bull periods, and many retail investors become, dare I say, overconfident in their own capability because everything is going up. They can throw darts at a basket of securities, and then those securities go up, and they start to question why they need a manager or any outside influence on their own decision making. And many retail investors are very successful in their own careers. They're the attorneys, the doctors, the businessmen, the politicians. Everybody
mm,
wants to have this portfolio of marketable securities because they're built for creating enduring wealth over time. And so as these participants start to look at the markets, and the markets are going up as they have basically since 2009, we get a scenario where there's less scrutiny on the individual fundamentals. People stop worrying as much about value investing.
correct.
Companies that have gone up in spectacular fashion may not have followed the value investing principles. So the media and herd mentality starts to think value investing doesn't work anymore.
Mhm.
But ultimately, value investing is investing. And if you're paying more than something's worth, it's fundamentally a poor allocation of capital. And so value investing will come back and be very apparent when we start and when we're in now these volatile periods, correction periods, bear markets, and recessions. People will go back to their value fundamentals,
Mhm.
and they'll start questioning the positions that they're holding as they fall 40, 50, 60%. And they'll recognize they really should be paying attention to the fundamentals, which is at the heart of value investing.
So with that being said, I heard a rumor on the street that you guys are doing very well over there. I've heard that you guys are printing money, so to speak. Can you talk a little bit about that to the extent that you can? And with that point, can you also touch on some of the securities that you're interested in today as of April 10th?
Yes. All right. Let's start at the beginning. I had a career on Wall Street and then launched Peterson Capital Management in 2011. So we're about 13 and a half years in. We have an annualized net return of about 12%. So we've done fairly well,
Mhm.
double-digit returns. And in fact, that's a very great return over that length of time. And I think what you're alluding to, we just completed our Q1 up 26%, which was a great return against the -4% of the S&P 500.
Mhm.
Uh, we're doing a few things that are very unique, and uh, I think theoretically I'll explain those because they should resonate well to your viewers. And this is how I think the best practices. This is the best practice for them managing their own portfolio. One, we have a highly concentrated portfolio. There are very few extraordinary long-term value investors that have been able to outperform with a widely diversified portfolio. I think maybe one or two of the exceptions would be someone like a Peter Lynch or
Mhm.
someone like a Joel Greenblatt. Other than that, most long-term value investors, professional money managers from Bill Ackman to David Einhorn to Guy Spier to Manish Bhai, hold very concentrated portfolios. That's true with Warren Buffett, and that's true with Charlie Munger. So the idea being that there aren't that many gems out there. There aren't that many outstanding businesses. There aren't that many outstanding management teams. And when you have an outstanding business and management team, the price is usually so inflated that it's very difficult for a value investor to get in. So there simply aren't 20 or 30 opportunities at any given moment, and you need to really concentrate your portfolio. And so we hold 7 what we call infinite compounders, businesses that are growing rapidly, where we were able to get in at very great prices. And we watch these holdings very carefully, and we truly consider ourselves owners of these businesses. So we might own 0.5% or less. We might own 2% of a firm. But the point is that we're very concentrated on the best possible companies. And so what happens is when you're concentrated, there are catalysts all over the place within our selected portfolio. And so whatever the market does is we'll have some weight on our portfolio, but because we have 7 core holdings that make up the majority of the positions, when one of those does very well, it has an outsized impact on the entire portfolio. And so one of the things that we've held for a while has been Alibaba.
Okay.
Alibaba's growing rapidly, extremely undervalued, I think very misunderstood. There's challenges in the Chinese economy. There's challenges politically. There's all these risks that are actually priced in and probably have brought down the shares considerably. And those shares went up quite a bit in Q1. They've pulled back a bit in Q2, which gives a new opportunity, but they went up a bit in quite a bit in Q1. And we had a few other things that went up, like Alibaba, or I mean, sorry, like Berkshire Hathaway, et cetera.
Mhm.
You know, this strong fortress balance sheet run by Warren Buffett. And due to some of these holdings and a nice rise in Baba, we had a really great quarter. And so nothing much changes. You know, we still manage these compounding positions, but it's the concentration that allows a single position to drive an outsized performance in volatile and down markets. So one, having a concentrated portfolio is definitely best practice, and over diversification is a very common problem in
Mhm.
society where people are allocating to something because they heard a tip on CNN or their neighbor mentioned something to them and they go out and buy it. And that's simply not the way to outperform and do very well. You need to focus really on the fundamentals. And when you find a great opportunity, you buy in big. And that will allow you the potential to outperform. If you have an over-diversified portfolio, you've literally put yourself out of the game. It's going to be nearly impossible to outperform something like the S&P 500 benchmark. The second thing that we do, and when you talk about printing money, I think this is the aspect that investors are referring to. We use a cash secured put strategy that I call structured value to move into a new position. So if we find an outstanding holding that we'd like to own, let's say that it's Berkshire Hathaway.
Mhm.
Berkshire Hathaway today is not necessarily the greatest buy in the market, but it's a solid long-term buy.
Mhm.
And at $500 a share, we basically, instead, if we wanted to buy Berkshire today, instead of buying the B shares for 500 directly, we might sell a put that goes out a series of time, and we might stagger when these puts expire, and we will set a premium or set a strike price, and the strike price could be a matrix of a variety of strike prices, both in and out of the money. And we'll pick up premium. We'll write puts on the security that we want to buy during the volatile period.
Mhm.
We'll be paid a large premium. And then if the shares fall into below the strike price that we've set, we will then purchase the shares. And part of our purchase capital comes from the premium they've paid us.
Sure.
And so ultimately we move into our long-term holdings at a discount to what they're selling for in the market price. And this gives us an enormous advantage, because instead of moving into something at, say, 500, we might sell a put, receive $50, committing to buy for 500 over the next 6 months. And if Berkshire shares dip below 500, we now buy the shares, but it costs us net $450.
Amazing.
And so years and years from now, after we've held the company for a long time and the shares are trading for $5,000, we will now make, instead of making 10x from
Mhm.
holding the stock, we'll make 11x because we've gotten in for less. And this adds a meaningful single-digit percent IRR to our performance over the long term. So by moving in at these below market prices, it lowers our denominator, it lowers the cost
Mhm.
to buying the securities. And on the flip side, when we sell, and we try not to sell very often, we try to buy right and then hold for the long term. When we do sell, we invert this entire process and we write covered calls. And let's say that Berkshire appreciated to 5,000 a share. Now we're sitting here, this is in theory, Berkshire's at 5,000 a share. We
Okay.
might write a call and say we're willing to sell for 6,000 a share. If we determine that it's now way above the intrinsic value, we think we have better opportunities.
Mhm.
We're looking at our opportunity cost of capital. We'd like to take the capital back out of Berkshire. Instead of just selling for 5,000, we might write a call for 5,500 or 6,000,
Mhm.
pick up another, let's say, 500 or $1,000
Well,
in premium. And then if shares appreciate to say 5,500 and we've earned 500 in premium, we may let go of the shares, but our net exit price is 6,000. So instead of buying for
mhm.
500 and selling for 5,000, we've set up a scenario where we can buy for 450 and sell for 6,000.
That's incredible.
And in that scenario, we've ended up with 2 or 3 additional doubles on our capital over a period of time. And even if that takes 10 or 20 years, that's a meaningful IRR
Mhm.
in each and every year. And so that is a huge advantage. And retail investors get confused because it seems like something only professional investors to do, but you can go into your Charles Schwab account, you can go into your Interactive Brokers account. If you have the cash available, you can go ahead and sell a put rather than buying the stock. And it is a better way to buy long-term investors in long-term investments.
Okay, that makes sense. I mean, there's so much to unpack there. You referenced Berkshire Hathaway, Alibaba. I guess just going back to Alibaba for a second. Before this interview started, I mentioned because of the opportunity that was available this week and last week, we were calling a lot of clients, and one of our positions as well as Alibaba, which we're very fond of. But a big concern that I was hearing from H&Is and family offices is that, Paul, there's a lot going on right now with China around the tariffs. And who's to say that, Alibaba and other companies will recover? I had my own rebuttal to that, but I was curious to see what do you say when people tell you that?
Yeah, that's I think, common concern.
Mhm.
There's a lot of political uncertainty around Alibaba. There's uncertainty around the UN and devaluation. There's uncertainty around tariffs. There's uncertainty around the VIE structure.
But that's
And
where the
these,
opportunity is, right?
that is, because these risks are very much overpriced. Uh, what I'm looking at is growth in their international businesses, growth in their cloud services business, and of course, their Taobao and Tmall core e-commerce business. Now, tariffs are going to impact things that are sold into the US,
Mhm.
and that is a very small percent of their overall revenue.
Yep.
And what I'm more looking at is the Chinese economy recovering?
Mhm.
And are the demand for Alibaba products and e-commerce products in general growing? And is the demand for the cloud services growing?
Mhm.
And these are growing substantially. Internet penetration is still growing in
Huge.
China. And so we're seeing volatile but consistent growth in revenue for the years to come. We see really strong cash generation capabilities. We see really strong buybacks, and we are pleased with the capital allocation
Mhm.
uh, strategies internally, which is highly important. And we've actually been pleased to see Jack Ma back in the public eye.
Yep.
So we're also very encouraged by the ability for Baba to incorporate AI into their business models,
It's gonna be
because
huge.
AI is going to be absolutely enormous, probably a big driver in the next bull market in the coming decade.
Mhm.
And we're trying to align ourselves where possible with these big AI firms. And between Alibaba and Tencent, they're going to be driving a lot of the AI development in China. And China is very capable with their population, their massive population. They have a very strong academic capability. This is, I think, a real opportunity. And although it's somewhat controversial, the growth rate in long-term GDP in China is meaningfully higher than US.
Of course.
And over the next 10 years or so, it is very likely that China surpasses US in terms of GDP
So you're not
and their
concerned that they
population.
they, they might not nationalize. That's not crossing your your mind over there. It's because a lot of people are telling me, hey, Paul, what happens if China nationalizes Alibaba and their other tech companies? My personal opinion to that is trillions of dollars of Western money would flow out of China. So I think it's a little bit too much risk on their part. Would you say that's
Yeah,
a fair?
I think that would really be disruptive to their capital markets. It's not to say that something like that wouldn't happen. And if it started to happen, we would we would potentially adjust our holding.
Mhm.
Uh, we have, although we categorize these in our infinite compounder portfolio, and we are hoping, we're looking forward to holding these for very long periods. When something dramatic changes that adjusts the long-term value of the business, we are very quick to adjust the holdings. So we have pulled positions out of our infinite compounder portfolio in the past. We've done sometimes rather abruptly as valuations changed. There were some of your viewers may be familiar with the Seritage situation that existed
Sure.
a few years ago. And after valuing 200 plus malls and reviewing extensive statements, meeting with management, reviewing all aspects of the business, doing probably more work than I think anybody.
You broke that
Uh,
story. You were the leader on that. Like you were early, but in the beginning and also at the end, you broke that news.
we owned it. We owned it, and it looked very promising for a long period
Mhm.
because uh, interest rates were so low, and the malls that they owned were quite valuable
Yep.
in many very promising markets. They own a mall in Redmond Town Center, which is next to Microsoft.
Mhm.
They own UTC in San Diego. They own a mall in Santa Monica. They have a mall near Fort Lauderdale, North Miami, Aventura Mall.
And
These
Matt,
malls are,
you
yes,
analyze each of these malls one by one. Is that right?
that's right.
That's incredible.
So when this Buffett, the background for maybe a couple of your viewers who don't know the story is that Sears was going bankrupt. Eddie Lampert owned a lot of Sears, and he
Mm,
spun out all of the real estate into a sales leaseback deal
mm,
where the real estate went external into a new entity, and then Sears leased from the real estate, but Sears filed bankruptcy.
mm.
So the real estate was no longer part of their assets, and it was a wise capitalistic move by Eddie Lampert. So suddenly, all of this valuable real estate was in a new entity called Seritage.
Mm.
Warren Buffett bought in, and Berkshire Hathaway lent uh, uh, basically billions of dollars to the entity so they could go in this capital recycling program. They were going to sell their low quality malls and upgrade the higher quality malls
Mm.
where they would get better cap rates and better valuations, and do things like expand the development in their parking lot. So they had this huge, like many hundreds and hundreds of acres where they could build like multifamily units in parking lots
Mm.
around these malls, and then restructure the malls in a certain way. Put in some anchor tenants like a grocer, gyms, etc., and create a little community around a mall and create a lot of value in that way. Now, what most people do in that situation, because it's a lot of work, is they classify the malls in buckets and they say this is class A, class B, class C.
Mm.
Here's the revenue, here's the cap rate, here's the value. What I wanted to be a lot more specific and go in there with a scalpel. So we started with the A's, and I valued every single mall. So there were 212 when we started, and it takes a while. Every mall is unique. And over time, when we got to the full valuations, it was there. We found that there was value in the $20 per share
Mm.
with our current cap rates, et cetera. What happened a few years ago is and by the way, after the COVID crisis, the shares dropped from about 40 to 6. That's when we originally found extreme value. So
Yep.
we were thinking the value could be in the 20s and growing, and we sold puts on the shares. Those puts went out about a year, and I believe we were buying the shares. We were actually putting out capital
Mhm.
in 2023. So in 2023 was when we were actually buying the shares at a discount to market, and the shares were appreciating, and I think they were around 11 or 12, roughly a few months into the year.
Wow.
when we were doing our analysis, interest rates were going up, cap rates were coming down, cap rates were going up, valuations are coming down.
Hmm.
And there were a number of things that were happening. There were some delays, entitlement challenges, and they were going through this change in business strategy where they went from the capital recycling program where they're going to grow the value of their top malls to concern about the market and a full liquidation of all of the properties.
Hmm.
And the property number had come down to about 75. So we'd gone from 212 to 75 because they'd been selling the properties. So now we had a much better view of these 75 remaining holdings. And we started to look, and a few months prior, we had done the revaluation and we saw $18 a share in the remaining properties. And then we did the valuation, we saw $12 a share. The shares were selling for 11 plus, but I'm somewhat of an expert in trend analysis. It's not rocket science. It's like we went from 20 to 18 to 12 over the course of a year, and interest rates were going up. These shares were going to go down. And so we stressed some variables further, and we looked and we said, look, these shares stock could be worth about 6. The valuation could be 6. And so even though this was in an infinite compounded portfolio, this was part of our core holding. It was over a long weekend where we got some information from public information was released from the company, and it was the details were alarming. It was not apparent. It was that suddenly they had more properties listed than we had counted. Why were there more why were there more malls in their expected sales than we knew existed at the company? And it was because
Crazy.
they were doing things like dividing malls into 2, but it just wasn't clear. And then, by dividing malls into 2, it doesn't make them that much more valuable. So when we started to see all this, I think I went on a podcast with Investing with Tom.
You told me, yeah.
And we got a lot of pushback on that podcast because basically I had been saying Seritage is great for a while. And then I came on and said, we've done the analysis again. It looks like it's going down. We're unwinding our position. We've basically reversed everything and we're out of Seritage. And we said, we think the value might be, I don't know, 6 to 8, I think we said at the time. And there was enormous pushback on that.
But you ended up being right. You called
That's
it.
right. I think the shares today are below 3. That's
You
right.
you
So
got in at the right time and you left at the right time. That's beautiful.
that's right. That's right. And in fact, although there's a very interesting follow-on now because we still look at these properties and there's only 15 left. And they're still looking to liquidate the entire portfolio. If you can go out and value Aventura, UTC, maybe Santa Monica and Redmond, there's of the 15 remaining, 6 don't even matter. They're so small. So you're sitting here with 9 properties. They have $240 million in debt to Berkshire and $70 million in debt to preferreds. That's $310 million in debt. And the market price the share is sub $150 million.
Wow.
So if the value of the properties exceeds $500 million, you might have a really great opportunity here. But there isn't a lot of growth. So there's a big difference between, and Paul, you've probably come across this in your own studies, but there's a big difference between a Ben Graham analysis and a Phil Fisher analysis. And the Ben Graham analysis might look at a company like Seritage and say, it's a buy. It's selling for 40% below its intrinsic value.
Let's take it.
The question is, how much of that intrinsic value will be eroded over the next 18 months as they liquidate the final properties?
Yeah.
And do you get sufficient discount to adjust for that? And then there's sort of like a bond. There's no real asymmetric upside here. So are you willing to buy into something for 250 where you might get 4? Or would you rather buy into something for 250 that's growing and you have potential over a long period of time to get 8, 9, 10, or 20?
The latter.
And you can just hold. That's right. So this is no longer a Phil Fisher type investment in any capacity. It's still, we know it so well. We know these malls very well. It's of interest. We watch them. If there was a real opportunity, and by the way, by selling puts as a tool to enter, you can lower this entry price even further. So Seritage still offers now offers a new potential Ben Graham type opportunity but it's far from the Phil Fisher opportunity that we saw originally, where
Yes.
they were going to recycle capital, compound these properties. We'd be in a growing REIT. Right now, it's in a full liquidation. But the whole point of this is that if something happened in China, if something happened at Baba, if the tariffs aren't going to have the impact on Baba, the same impact on Baba that they are going to have on Pinduoduo.
Hmm.
They're not deriving 50% of their revenue from US sales. And because of that, the tariffs will impact a small portion of their revenue at a fractional level. So we're always looking at the valuation. Alibaba looks so undervalued. In fact, by our metrics, I think that this is like a $1 trillion business
Well.
in the next 15 years or so.
Hmm.
So this is a massive, outstanding Phil Fisher type opportunity. And if it looks like something's going terribly wrong, we will do what we did with Seritage and we will exit and we will find a new opportunity. But we're hoping for the best with Alibaba. We hope that the governments can collaborate and cooperate.
Yeah.
And hope is not a strategy. What we look at is the fundamentals of the business, and they are
Mm.
strong. They are growing. It's a global entity.
Mm.
China is well respected around the world by many countries.
Major player.
Major player in the world. There's no reason to have a position to not have a position in a massively growing country, economy, and business and industry. Alibaba is selling for like a tenth of the metrics and multiples as the Mag 7 companies here in America.
Mm.
And maybe the Mag 7 are overpriced, maybe Baba's underpriced, maybe there's some more equilibrium level where things can resolve. But right now there is a massive gap between values in China and values in America. And part of the thesis is over the next 10 years, as GDP increases, that gap and of multiples should maybe not close completely, but it should diminish.
Exactly. Oh no, listen, I'm totally with you. It's the contrarian approach, and the opportunities because there's volatility, and people are very skittish about China, which makes it a very good place to look for opportunity, I would say. Um, I'm curious, are there any other businesses at the moment that you're maybe fond of that you would like to highlight? And if not, if you want to keep it private at the moment, that's totally fine. And then I also want to ask you about portfolio construction. How do you guys, you know, create your basket, and then how do you allocate the capital? You mentioned you're very concentrated, but do you ever say we're never going to go more than 20% or 30% in one security? Or do you take a little bit more of the pariah approach where you're like, okay, if it's a really good business, I'm willing to let it grow as far as a percentage of the portfolio? How do you think
These
about
are these are really great questions, and uh, they're difficult questions for individuals at the retail level to answer. I'll tell you what I believe to be the best practices, the way that we implement things. First of all, we can discuss, other positions, but I'll tell your viewers, we write these extensive reports, annual reports in particular. They're on our website at petersonfunds.com. And so we go through extensive analysis of the infinite compounders. We show everything that's in the portfolio.
it?
I'm sure there's a number of investors out there that simply replicate our portfolio. But if there are other questions about specific positions, anybody can definitely reach out. In terms of, and I'll even highlight one, which is I think Daily Journal is kind of attractive at the moment.
Mm,
And it's come down considerably during this volatile period,
mm.
almost maybe 40%. We've been a long-term holder,
Wow.
and we own about a little less than 1% of the shares outstanding. And there are wonderful investors that have also purchased a meaningful percentage. I think Guy Spear owns some of Daily Journal, and some other fund managers and reputable friends of mine have bought in. And it's an outstanding firm that used to be run by Charlie Munger, and it's got a really nice long-term tailwind, and they're doing all sorts of technology implementations for courthouses around the nation and world. And so that's a really nice growing long-term compounder that we expect to hold for a very long time that I think will do very well for us over the long term. In terms of the portfolio construction, Paul, we go through a very rigorous step-by-step framework
Mm.
where we add alpha in each step along the way. The first step that we do is we analyze 13 Fs from super investor portfolios that we admire and know well. So we actually are looking now at about 100 different portfolios every single quarter.
Mm.
The SEC requires that managers file their holdings, a snapshot of their holdings every 90 days. And we've written software that basically extracts all of these 13 Fs from the SEC. It's all automated and it puts it into a nice matrix. It shows us what these 100 investors are owning, and it gives us a superset of all of the firms that the great value investors in the world own.
Mm-hmm.
And we then compare that against the historical ownership, and we see exactly what they're buying, selling, holding, and we get a whole lot of information. We do a divergence analysis where we see at the large level, at the full 13F analysis level, what sectors are attracting more capital, where there's capital leaving. So we get to see really high quality capital flows very early. And this works very well. This doesn't work well with high frequency trader portfolios.
No.
This doesn't help if, because they're filing about 45 days after the quarter close.
Mm-hmm.
So what you need are really long-term investors that also concentrate their portfolios. You need somebody who's managing $1 billion, but is willing to put 20% into one stock.
Pretty good sign.
So when Bill Ackman's buying Nike, it doesn't mean that we just go and buy Nike. It means we get a chance to look at Nike, and we know that Bill Ackman and his team has probably spent hundreds of thousands or millions of dollars doing research. They've spent months, quarters, and years. They have a strong track record, and they've placed a big bet with their client capital into one holding.
Mm-hmm.
But they have presumably evaluated the opportunity cost of that situation. And then we can just look right where they've already discovered that something might have an opportunity. And so the superset of these 13 Fs will generate for us about 400 to 500 companies to review. Now in the US, there's over 5,000 companies that are publicly traded. So we are immediately eliminating 90% of the companies. And if those 90% haven't shown up on any of these 13 Fs,
yep,
it's unlikely that there's something truly there. And we won't necessarily restrict ourselves from that opportunity. Maybe there's a reason that opportunity doesn't fit in the other portfolios. Maybe it was just too small, or there's some nuanced situation that happened recently where we can actually have an advantage and go in. But at the fundamental level, we are pretty well focused on these 400 firms that are within the 13 Fs. And we start doing a fundamental analysis. So step 2 is we go into the fundamentals. We start analyzing every aspect. We have some automated pieces. We have some pieces that are just the old manual way of reading through the financial statements and understanding the competitive advantages and looking at the management teams and trying to evaluate the future cash flows.
Sure.
So we are doing the full fundamental analysis to determine companies that might qualify for our very strict parameters to make it into our infinite compounder portfolios. We only have 7. So to become the 8th, you have to be like this extraordinary opportunity. So the third, yes, go ahead.
How much would you let one security grow to before you shave it?
Paul, the best practice is not to trim your winners.
Yeah.
So, and theoretically, that would allow you to become more concentrated. So if we have 7 holdings, certainly there will be some that grow faster than others, and there may be 1 or 2 that is, I don't think that there are any that are, for example, shrinking when we anticipate they're growing. We see the numbers. We know they're growing. However, there might be one or two that don't perform well, of course, and we have to maneuver and exit. But for the remaining, there might be two or three of these seven that carry most of the portfolio over the next decade or two.
Mhm.
And so what tends to happen, if you look at Nick Sleep's portfolio
Okay.
years ago, that portfolio became super concentrated, but originally he started out a little more diversified. And so ultimately, how I would like to say we wouldn't trim much.
Beautiful.
Uh, when the positions are growing, if Berkshire suddenly became this outsized position, it would be a mistake to sell Berkshire and buy Baba because maybe Baba is simply in a structural situation where it can't perform as well as Berkshire. So you don't want to cut the roses to water the weeds.
Yep.
You want to cut the weeds and water the roses.
Mhm.
And so we like to let these positions really run. We tend to be concentrated and we tend to make big bets. I don't have a problem uh, with strong conviction
Mhm.
allocating 10% or more to a single holding. And then as that starts to appreciate, it can become very large.
I love it.
So we tend to let our winners run.
Matt, okay, so that's perfect. That's definitely the Peter Lynch approach, which I personally love. Um, Let me ask you something. What is Veritas Alpha? I keep hearing about this thing. What is that?
Yeah, so Veritas Alpha, it's a great question. So it's sort of in beta mode right now, Paul. So
I
you're
I feel
very
like it's a hidden
early.
secret. I mean, tell us
Yes, you
about it.
have it. You have a hidden secret. So we've actually put it up on our website, which is a little easier to find. We haven't done any
Okay.
marketing or anything for this, and it's actually totally open and free right now. So anybody can go in and use it.
Okay.
Uh, you can go to our website, that's it easy, or you can go to veritasalpha.com. And what we've done is we've created an AI analyst. And this AI analyst is I'm working with it every day. I'm using it every day.
Mhm.
We have a number of tools. Uh, Ultimately, what we're doing is we are performing professional enterprise quality equity analysts on individual securities in minutes. So we have built a fully integrated, full stack, AWS based analyst agent where we can put in any ticker we want and create a full analyst report. Uh, in my experience and in talking with many outsiders, it's really common. If you have a set of analysts working for you, it's common. Maybe an analyst would get through 12 to 15 companies a year that they could
Mhm.
know extremely well.
Mhm.
Maybe it's a month that they would spend to produce a report of this quality. We have tried internally to produce the top quality analyst report in the world. And we've made it totally scalable because we did it for one firm and we based it all in our Python scripts sitting on top of AI. We can now scale and run it across any firm. So in about 15 minutes, you can put in a ticker in your email and it will send you the report that you request in real
Great.
time. And instead of it taking a month or costing thousands of dollars, it's immediate and it's really complete, comprehensive. We do SWOT analysis, 4 to 5 forces. We go through all the scuttlebutt questions. We do a risk analysis. We do intrinsic value analysis. We have a short thesis. We do a NAV calculation. We do a bull bear based DCF. We incorporate some appendices with financial statements, et cetera. And these are about 30, 40 pages. And as you start going through them, you just see how much time and savings. So that is one of the many tools that we've created with Veritas Alpha.
Mhm.
Uh, shall I continue? There's another tool.
Well, I was just gonna say when we were
Yeah.
together in Austin, you showed it to me in person, and man, it blew my mind away. It's like something that would take a top Goldman Sachs investment banker weeks to create. You and I
Yes.
created it in 10 minutes. It's totally insane. Can you just
Yes.
say one more time for the viewers and listeners, where could they go to use this themselves, either in retail or in the professional world?
Yes. So because we're doing just beta versions, and we've been working on this for a couple of years, but we initially started building it for our own use, and then there
Mhm.
started to become a little bit of external demand, so we put it up on a browser. So anybody can go to veritasalpha.com, and they can look at the real UI is right there on Veritas Alpha. We also on petersonfunds.com have a page on our website where you can access the exact same tools. So what we are doing is deep equity fundamental research, and it's fully automated. There are no human eyes on it. We've written
Mhm.
all the scripts, imported all the formulas. We have thousands of lines of code on the back end of this
Mhm.
that's driving all of the prompts and things that are nuanced for each individual company and sector, and it produces a very reliable report.
Mhm.
Some numbers, verify the numbers. This hasn't been looked at by human eyes.
Mhm.
So you go and you look, and if something stands out and seems inaccurate, go and check. And what I like to do is I like to take these reports and upload them into ChatGPT or Anthropic or Gemini, and then start asking questions on the reports. And the reports, by the way, they're not hallucinating. We have developed all of the proper connections. So we have API connections into the SEC. We pull
Wow.
all the data directly from the financial statements of the SEC, and we put them into AWS, and we're extracting real-time feedback. We're pulling transcripts from earnings calls. We're pulling annual reports. We're taking in all sorts of information that an analyst would actually be analyzing to produce these types of reports. We've just programmed AI to do it for us. So on that note, one of the things that takes a lot of times for investors is listening to all these earnings calls, evaluating all these earnings calls.
Mhm.
You can imagine if you're trying to track 400 companies that
Mhm.
are on these 13Fs, that gives you 1 month where you have 400 hours of calls to join,
Yep.
and then you've got some analysis to do and some updates of your models, and it's totally unmanageable.
Mhm.
And so what we created was a uh, earnings summary report that's about 7 pages, and it goes through all of the feeds that we discussed. It pulls all of the right primary resources, including the transcripts, and it summarizes everything for us. It tells us about management tone, what changes were made. It goes through the whole Q&A of the analysts that are asking questions. It states the question and the direct quote of the answers.
It's insane.
It goes through everything, and it takes a matter of 10 minutes, and you can order them in parallel. So it's like 10 minutes until you get them all.
Mhm.
So if you needed in the past go and listen to 400 calls to do your role at the office, you can now run the 400 reports, get through a report in 2 minutes, figure out where you need to spend your time, and then focus on the 10 that matter. So this is an enormous time saver for us. And in addition to saving time, what it does is it allows us to totally scale. So my analyst, Andrew Park, and I have been working on this for a number of years, as I mentioned. And what we do is we focus on how we would analyze one company super well, and then we branch it out and we run it on like the whole S&P 500 or the whole Wilshire 5000. And so actually, what we did recently is we were looking at a number of metrics over a 20-year period. So we wanted to see what was the multiple expansion and contraction in Apple shares in price to book, price to sales, EV to EBITDA, all of the standard valuation metrics. And we wanted to see how did that look over 20 years?
Mhm.
When was Buffett buying? When was Buffett selling? How,
Mhm.
at what point was there ever a point that the price to book was below one? And if we looked over a 20-year period, even if that happened during recessions, corrections, and things like that, that that level of contraction is totally possible again in the future. You wouldn't be buying it at an inexpensive price if you're paying multiples of contracted multiples.
Right.
And what we've seen from 2015 to 2025 is that all of those multiples have exploded.
Mhm.
And so where Buffett was buying, these multiples were really contracted. And then what happened is we had earnings growth and we had multiple expansion, and then Buffett sold, and it's all at these really high peaks. So we looked over 20 years, and it's very interesting to see that. And it was a little exercise we did. Once we were done and completed this for a single stock, just having the formatting right, the graphics correct, we were then just simply able to lay it over the S&P 500. And in 2 hours, we had a 500-page document that did it for all.
Oh my
And
God.
then last night we ran it on the Wilshire 5000.
Holy
And
smoke.
when we're done with this podcast, I'm looking forward to my 5,000-page document that actually sorts the relevant companies by the most contracted multiples. And so now I can see the obvious buys and the obvious sells, and we can dive into research.
This is incredible. So obviously, we're going to put this recording out and hopefully get it in front of as many people as possible. But I think you also referenced the fact that you're hosting a very big party or gathering at Berkshire Hathaway at the annual meeting.
Yes.
Is it going to become more available to the public then, or how does that work?
Yeah, look, it's available. So Paul, there's nothing restricting people from going there and using it.
Mm.
If we get too many users, we're going to have to put up something because they're going to be running on all of our tokens. I mean, people can use it and we're paying for it. So there, this will be the 10th year that we do. We used to do something called the Berkshire Backyard Barbecue.
Hmm.
And that evolved very organically and ultimately ended up with like hundreds of people, couple of billionaires, everybody walking around in my friend Quentin Smith's backyard in Omaha,
Cool.
Nebraska. So it turned into this huge event, very informal. We had tents set up. We had, people were signing books. It turned into quite the ordeal, but we were always gambling with the weather. And 3 years ago, we did a big upgrade to the Omaha Press Club. And by moving to the Omaha Press Club, we've moved everything downtown. It makes it more convenient for people. It's a different atmosphere for sure. The backyard barbecue is really laid back. This is business casual kind of affair. It's very, very nice. And certainly, I don't think many people know about Veritas Alpha. So I imagine that as we have a few hundred people around, people will start to talk about it and hear about it. And I do think we are always these documents, the quality is always improving and evolving. We have a number of developers doing Python daily, actually around the world. So we're actually doing development 24 hours a day.
Hmm.
And as these reach, they're of very high quality now. I think over the next few weeks, the quality will improve even more. And at some point in a couple of months, I expect we'll put some sign-in login pages and probably ask for a small fee from either this is for enterprise or retail investors. Enterprise would probably like to use this, but we'll probably put in a lower tier. Maybe it's 100 a month or something for people that just want to use it. I think it will add considerable value.
Which is
And
nothing in comparison to the cost of an analyst or an associate.
no, what's coming, the reason, Paul, is I like to learn about these new trends by using them. So when ChatGPT came out, it was so apparent that this is a monumental shift that the first thing we needed to do to understand how all this AI was working is start using it.
Mhm.
And then to use it, we needed to build on it. And then we could find, is this going to be profitable? What these business models look like? And so we've just consistently been stepping forward and utilizing AI, and it has totally transformed our workflow. What we have seen here is that it looks to me like there are massive disruptions coming in the white collar workspace. I can produce legal documents on my own. I can do extensive scalable analysis. It might not be that analysts are not irrelevant. You need to be a very capable analyst to understand these reports. It's just that you don't need 10 analysts.
Right.
You need one or two. And so this is going to be a big disruptor. There are currently, I believe, 5,000 individuals, and these are highly qualified individuals, doing equity research on US-based firms.
Mm.
5,000 individuals. Uh, I think that uh, there's going to be a much more difficult on-ramp. And I think some of those analysts, as they retire, move on, career shifts, et cetera, I don't think they'll all be replaced. I think we have probably, uh, let's say, excess capability in the equity analyst space, and maybe some of those folks can go out and do their rocket science and chemistry and get back to physics. Because I think AI, the scale that's capable, will allow us to reduce the manpower behind equity analysis.
Sure. That's one of the things that Greg Simons was telling Greg Simons,
Jim,
Jim Simons, when he was talking about sorry, Greg Zuckerman, rather, when he was talking about Jim Simons, that the change in technology is going to spur people to go back to academia, which Jim Simons was actually pushing for. And that's why he started Simons Foundation here in New York. So it's kind of funny to see a prediction that was made 10, 20 years ago is kind of coming to fruition, so to speak.
yeah, I think he had extensive foresight and vision. So uh, I don't know. This may not happen tomorrow. To me, it seems apparent, but in most, uh, Paul, I was speaking in Dubai late last year, and I brought this up to a number of my friends in Switzerland and other places around the world.
Mhm.
There is considerable pushback in the financial industry against the capability of AI. Some people are very concerned that it can't do math, but it does math perfectly. Uh, People are concerned with the hallucinations. I had between Gemini, ChatGPT, and Anthropic, I produced a much more difficult uh, CFA exam to test our AI capability, and it passed the 6-hour exam with one wrong in under 2 minutes.
Wow.
So it's like having a super analyst CFA designation holder that you can chat to about your deep questions and
Yes.
get really insightful answers. So there's a little bit of a learning curve for many funds. I don't think many funds have put this into their workflow, but it is coming and it will change rapidly when they do. I think in Dubai, I made this statement and I think I borrowed it from somebody, but I said, AI won't take your jobs. A human using AI will take your jobs.
Right.
So you either get on the wave and start utilizing AI in your own workflow, or you will become obsolete.
Exactly. Matt, before I let you go, the last time you and I were together in Austin, Ken Majimuda, our good friend who owns Capital Alliance, was kind enough to bring us together and make the introduction. I learned in our conversations there that when you built this amazing business that you have today, you were kind of inspired by folks you built a wonderful relationship with, like Guy Spear and Arnold Vandenberg, and probably countless others that are not coming to mind at the moment. Maybe you could speak on it. But I'm just curious, what did you learn from those individuals that kind of help you grow as an investor and also as a fund manager?
Oh, I've learned so much from these relationships. Guy is a wonderful person. Guy is a friend. We met about 14 years ago. I think I met Monish Pabrai in 2004 at a
Wow,
Dairy Queen in Omaha.
cool.
Uh, I think it really, well, one thing that resonates is something that Peter Kaufman told me. Peter Kaufman was on the runs Glen Air and wrote Poor Charlie's Almanac
Hmm.
on Charlie Munger, and was on the board of Daily Journal for a while. And I got to know him back when we were living in LA. Uh, and he was explaining to me that there's basically two strategies. There's the A plan and the B plan. The A plan is you work alongside or as closely with the greatest mentor or inspirational person you can find in your life, and you work for that person. If you want to be a great fund manager, you should do everything you can to just be working for Warren Buffett or someone in a similar category.
Hmm.
Uh, And I think that's extremely important. Plan B is to learn from them vicariously and implement everything they do without actually knowing them. And I wouldn't say that I go out there with an intent to like better myself, but I'm not trying to go out and take advantage of any of these relationships. I'm an admirer of these people. I think what they've achieved is very difficult.
Mhm.
Uh, and I think that they're well accomplished. And so I built a wonderful relationship with Guy. I think Guy's a phenomenal individual. And he cares very much. So whatever I learned all sorts of aspects. Uh, from Guy in particular, it was a lot more about marketing and running the business. I really
Mhm.
learned about how to make the fund reach the next level.
Mhm.
Some of the core fundamentals we all knew before we knew each other. We all read, we all read The Intelligent Investor and Security Analysis. We all read Phil Fisher's books, and uh, so we know the principles, and and it's nice to compare notes on individual investments. But Guy was really influential in helping me uh, gain confidence in writing reports before I knew if there would be an audience to read the reports, or to look at how to grow the business and, of course, deliver great IRR for the partners, but
Mhm.
also add ancillary value to the partners, whether it's by offering an internship program for some of the partners' children, or if
Mhm.
it's for making connections and introductions. There are a lot of ways in our business that you can add value to the partners and make a really cohesive ecosystem. And so by building like a very sticky ecosystem where you're adding value outside of the IRRs, uh, I think there's more acceptance and tolerance for a concentrated portfolio that will be volatile. Guy also taught me, I think this is quite powerful. This was, I think, highly transformative for me. Uh, Guy taught me that, or showed me that sales, before I was really connected with Guy, he taught me that I was out there doing one-on-one sales regularly,
Mhm.
taking calls, meeting with investors, meeting with somebody's wealthy uncle. And when we got on a call or met in person, it would be an explanation from the very beginning, and the individual wouldn't necessarily have any interest. And it was a very hard sale to close, right? We have a $2 million minimum. We have an exception for down to 250,000, but I'm going to sit down at lunch with someone and teach them about my fund and ask them for $2 million.
Mhm.
So it was very difficult. What Guy taught me is to build an ecosystem and then let the people come to us. And that was transformative. It freed up a lot of my time. Our close rate went from 1 or 2% to like 50% or higher.
Wow.
Now what happens is we put things out, we go on podcasts, great podcasts like yours, Paul, talk to great people. The word gets out, we release great reports. We do analysis, and sometimes we publish that analysis, like with Veritas Alpha. And ultimately, we get inbound inquiries, people that are really interested in what we're doing. And that's a much better way. It takes a little bit of time to establish that brand and
Mhm.
to establish the marketing. I would say 3 years, but we had to pivot at one point because I was mentioning to you years ago, I would just be cold calling people,
Yep.
and eventually it gets exhausting and it takes time away from the analysis. It's much better to focus on doing great work, put it out there,
Mhm.
have people hear about it, and then they come to us.
Exactly.
So we get inbound inquiries on a regular basis. We raise capital quarterly, uh, and uh, and it's a great time to invest. So I hope people are coming to you, Paul.
Mhm.
We hope people are coming to us. But I do very little, almost zero outreach at this point. It's inbound inquiries, and that's it.
How about with Arnold Vandenberg, who we had the pleasure of meeting in Austin because of your wonderful connection with him? Such an amazing man. He had such an amazing story. And, I read both those books he suggested, one that he gave
Yes,
us. And you'll be happy to know I've been practicing my affirmations almost every day. I've been
great.
trying to be religious about it, but he was absolutely right. It is a game changer because some of what you tell yourself is not always positive, and it definitely translates and correlates to what you do out in the world, whether it's in your personal life or professional life.
Yes, Arnold Vandenberg is one of the most incredible individuals alive. Uh, I've known him personally for about 5 years. I've become very close with him. I consider him a great friend. He's 85, Holocaust survivor, spent the early parts of his life. He was born and lived down the street from Anne Frank. And from about 2 to 6, he was in an orphanage and through the Holocaust lost uh, almost every member of his family. I think 32 members of his family. Ended up moving to LA and had a very difficult childhood and managed, despite everything against him, managed to overcome all of that and overcome all of this negative ideology and thought. I mean, it was like, he would, I think, share the same that it was like a toxic relationship with himself. He was destroying himself from the inside. He had no uh, value for himself. He was a troubled child, always in fights, very angry,
Mhm.
and he transformed himself completely after his teenage years. He transformed himself through the power of his subconscious mind. He's been practicing this for 50 years. He's written 50-page volume books that he hasn't published that I've had the pleasure of looking at.
Wow.
And he is basically Think and Grow Rich is one of his favorite book recommendations. All of the Jack Allen books he loves. James Allen, I'm sorry. And Jack Allen is a local restaurant where I meet him and discuss these things. James Allen, and he really also likes the book The Genie Within.
Mhm.
And so, Paul, you were with me. We had the pleasure of listening to Arnold for, I don't know, maybe 5 hours
It was amazing.
as he spoke. And and he's he's a huge advocate of affirmations, and he makes them up for himself. One of the one and he believes that thoughts become things. So
Yes.
basically, he eliminates negative thinking from his mind. He gave me a little analogy a few years ago where he said, I think you have 14,000 random thoughts throughout the day, and most of them are habitual. And you're not even aware of these thoughts coming into your mind. You're not aware that you're doing it, but you're having these thoughts, and you're having the same thoughts that you had the day before. And most of them are negative. I think it stems from the amygdala and other aspects of evolution and the biology of how we're driven. So it's better for survival to be a little more cautious. And so in this day and age, we're regularly cautious, and we're always telling ourselves negative things, worrying, for example. And worrying is like praying for what you don't want.
Mhm.
So he's told me, imagine that a positive thought is a yellow dot and a negative thought's a black dot. And if you have a positive thought, you put a yellow dot on the paper. And by the end of the day, you filled your whole paper with 14,000 thoughts. How does your paper look? He asked me. I said, well, I don't know. I don't know. I don't know. It probably looks like a bunch of yellow and black dots, I suppose. And he claims that his paper is completely yellow. And when he opens his wallet to show me some things, there's like affirmations that are falling out when he opens
Mhm.
his bag. So he's always saying, every day in every way, I'm getting better and better,
Yep.
and all of these various affirmations like that. He's also always telling himself things that he's made up to help motivate himself. Why sit when you can stand? Why stand when you can walk? Why walk when you can run? And if you see some stairs, climb them.
Yes.
And because of that, I've ended up in situations where I'm like going to Arnold's office with Arnold. Suddenly he disappears and I'm in the elevator and he's taking the stairs. The guy's 85.
Matt, I'm standing on one
So
leg after he told me that. I'm standing on one leg
yeah,
when I'm not doing anything, and people are like, "This guy
right,
lost it. He finally lost
right, right.
it."
So Arnold's done a number of things in private with me, like full on yoga positions, balancing on his hands, things I can't possibly do.
Listen, if a
4
guy
years
if
younger.
I was telling my friends, and they're like, Paul, like they know me. They're like, I'm not this type of guy. They're like, Paul, you're doing that? If a guy that built a $3 billion business is telling you to stand on one leg, you stand on one leg.
That's right. That's right. So
But
it's helpful. It's beyond helpful. I
yeah.
mean, all of the this is a very difficult business, very competitive business, and it's very taxing. I think psychologically,
Yeah.
emotionally, we all try to manage that. But I found, a retail investor is always many times will be fearful and scared and worried about things. I've said to many of our investors, we are still human. Us portfolio managers, Paul, we're still human. We still have the emotions.
Mhm.
We just know about the emotions. So we know that maybe the emotions are not telling us something that we should act on.
Yes.
And we need to like bury those emotions and think rationally. And so having someone around like Arnold, where he's gone through such extreme challenges in his life,
Hmm.
overcome them all, and done so seemingly with this positive mentality and vision and view. It's just the right way to live, and it's made him an incredible person. He's a mentor to many great investors. He's built an incredible firm. He has an incredible family. I've learned more uh, from just watching his actions. The way he is in life is so outstanding. He's truly one of the greatest people. He's like a living Warren Buffett. He's a living
Hmm.
legend. He's in a number of books, the 99 Greatest Investors in the World. He's in uh, uh, so many different books. He
William
just
Green's book.
so
Yep.
William Green's book, Richer, Wiser, Happier. He's been profiled in a number of stories, and I think at his peak he was managing about 4 billion. And by
Mm.
the way, he has a 50+ year track record of
Mm.
13.8%. So people lose track of what's good and bad in a bull market. They think you need Bitcoin and Tesla. One of the greatest investors in the world,
Mm.
who's alive right now managing a fund, has done so on the back of a 13.8% track record over 50 years. So
Yeah.
that is an outstanding track record. That has allowed him to turn, $10,000 into $6 million, for
Exactly.
example.
I had the pleasure of speaking with him in private, and I wanted to make sure I got his exact mantras and affirmations. And he explained to me, similar to Muhammad Ali when he was coming up, he had to tell himself he was the greatest because when you do that, you know to act and conduct your life in a different way. So his affirmations were, "I'm a successful money manager," and the second one was, um, "I'm happy, wealthy, I'm happy, healthy, wealthy, and wise." And that
Yes.
was what he practiced for 50 years, just for our listeners. And please do read the William Green's book because it's really good. Matt, I know you're a busy man. I know there's a lot going on in the markets and there's probably a lot of investors calling you, so I don't want to hold you. But for folks that want to get in touch with you, either to invest in your fund, maybe attend your Berkshire Hathaway meeting, or hopefully get in front of Veritas Alpha because it's revolutionizing our investment industry as we know it. How could they get in touch with you?
Yeah, great. The best way is probably to start by visiting our website at petersonfunds.com. Uh, you can always send me an email, matthew.peterson@petersonfunds.com. That's probably the best way to find me. I'm on Twitter and all the social media pages. We have a pretty extensive YouTube platform. We have videos, annual meetings. If anybody's just interested in learning more, they can definitely visit our YouTube channel. But ultimately, if somebody wants to talk about Veritas Alpha, Peterson Capital Management, or any of the topics we've discussed here, they can just send me an email and we can set up some time to discuss.
I love it. Matt, thank you so much for joining us.
Thank you, Paul. It's a pleasure being here.
Nice seeing you again.
Good to see you too.